I remember back in high school, I had a really difficult chemistry test. The average score was around 65. I sat there as a 17-year-old feeling pretty good with my 77 written boldly on the top right of my page. That is until I spoke to Mark, the student in front of me. We had very similar last names, so we often sat near each other in classes. Mark was brilliant. He was a straight A student. He was even taking college-level classes senior year. After high school, he wound up at Harvard University and eventually got his PhD. Anyway, back to the chemistry class. Mark got an 87 on this ridiculously hard test. Obviously, that was much worse than the grades he was accustomed to getting, but relative to the other students, he was actually doing really well. I remember the teacher even joked that he may have to curve the test to pull up everyone's grades, but if he did that, Mark would end up with a score of 108. It is difficult exams like these that make the true geniuses shine. When an easy test is given, it can be difficult to tell who has real talent, since everyone receives a high score. But when an especially hard exam is given, it allows the brightest students to separate themselves from the rest. It's like the old saying goes, the cream always rises to the top. Just like the hard chemistry exam I had in high school, stock market declines and corrections help us spot out the strongest stocks with the greatest potential. When the market enters a weak period, heavy selling comes into the market as traders seek to raise cash. However, not all positions are liquidated equally. When fund managers are reluctant to sell certain stocks, these companies hold up relatively well compared to their competitors. When legendary investor William O'Neill did his study of the greatest winning stocks of all time, he found that corrections were actually an investor's best friend, as they allow the shrewd market participant to spot out which stocks have the potential to be true market leaders once conditions improve. The key is to watch the stocks that hold up best while the market declines, and to buy these stocks as they emerge to new price highs. So how can we go about spotting stocks with relative strength? The first and easiest way is to monitor stocks making or within striking distance of a new price high. Let's say the S&P 500 was down over 15% from its prior high, and stock XYZ was in 5% of a new high. Without knowing anything else, we can deduce that, like Mark, this stock is drastically outperforming its peers. A second way to determine stocks with relative strength is to look at the most recent low. If the market makes a lower low while a stock makes a higher low, that is an indication that the stock may be beginning a new uptrend before the general market. Finally, using the price performance line or relative strength line developed by William O'Neill can also be a way to spot out especially strong stocks. O'Neill developed a system to grade stocks from numbers 1 to 99, with 99 signifying that the stock had outperformed 99% of its peers over the last 6 months. In addition, he would include a relative strength line on each chart to compare how the stock was performing compared to the S&P 500. When the RS line was at a new high, O'Neill would make a special note to indicate the stock was one showing enormous potential. While most investors fear and despise market corrections, the truth is they are often a trader's best friend, since they help put a spotlight on stocks that are showing exceptional strength. Don't let the next bear market or correction get you down. Remember, they are crucial parts of the market cycle that literally lay the foundation for the next big market winners.